Running an e-commerce business requires investment, and those costs often occur before revenue comes in. Inventory has to be purchased before it sells. Marketing has to run before customers convert. And when a slow month hits, payroll still needs to go out. That gap between spending and earning is where financing comes in. There are two broad categories to consider: short-term financing for immediate needs and long-term financing for bigger strategic moves. Let's break it down. A business line of credit lets you draw funds as needed, up to a set limit. You only pay interest on what you actually use, and your limit revolves, so once you repay, you can borrow again. It can be a good option for bridging cash flow gaps or covering those unexpected expenses that pop up. Just be careful with the interest rates and the temptation to overborrow. Working capital loans give you a lump sum up front. The repayment terms are usually shorter than a standard loan, and payments are typically structured as fixed installments, so you know exactly what to expect. Merchant cash advances also give you a lump sum, but the repayment is a fixed percentage of your daily or weekly revenue. The speed of access is the big appeal here, but it can be expensive. Since repayments are tied to revenue, they'll drop when business slows down, but your repayments and effective interest rate can be high when you have a good month. Business credit cards offer revolving credit for day-to-day purchases and help build your credit history. They're probably the most convenient option and can make it easier to qualify for other financing later on. But watch out for high interest rates on unpaid balances and the risk of overuse that comes with that convenience. Inventory financing is built specifically for stock purchases. It lets you prepare for demand spikes without giving up any equity in your company. Just be aware that the inventory itself becomes the collateral on the loan. This can keep interest rates down, but it can also put you in a tight spot if you get behind on the payments. Now for the long-term options. These typically mean larger amounts, longer timelines, and more involved applications and approvals. Term loans give you a lump sum with a fixed repayment schedule. These work well for significant investments like buying equipment, expanding, or purchasing property, where the benefits align with the longer repayment timeline. Interest rates are generally lower than short-term options, but you will need a solid credit history to qualify. SBA loans are backed by the Small Business Administration. Microloans go up to $50,000, while long-term loans for major assets can go up to $5.5 million. The terms are typically favorable, but the application process is long and the eligibility rules are strict. Crowdfunding lets you raise small amounts from a large group of supporters. It can be a great way to validate a product idea and build a customer base before you launch. Equity financing involves selling shares in your company in exchange for capital. Venture capital is the most common version for startups chasing high growth. Equity dilution is crucial to consider here, and it's important to remember that venture capital is milestone funding. It's meant to get you to your next stage, not to sustain the business indefinitely. If you've already raised a venture round, venture debt might be another option. These loans can extend your runway without significant equity dilution. Which option makes sense depends on where your business is right now, your credit profile, and the timeline for how you're using the funds. The full breakdown of every option is on the Mercury blog, and you can find the link in the description.